Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 139th CP program organized by AASB for this council year. Today we are organizing 139th program for this council year, and again topic is very important, that is the auditor's responsibilities relating to fraud in an audit of financial statement, SA 240. In order to cover various intricacies in SA 240, we are having with us two learned speakers, very respected C. Anil Gupta ji and CA Paul Alvarez sir. So, on behalf of AASB of ICI, I extend my warm welcome to both the learned speakers. Welcome to you, Anil sir. Welcome to you, Paul sir.
Thank
We
you.
are having two moderators with us, CA Prashant Mishra ji, CA Drishtri Rana ji. So, I also welcome both the moderators of today's webinar. I also
Thank you.
welcome all the participants of today's webinar. So let us start the webinar, and without wasting much more time, I request Prashant Mishra ji to please start the further proceedings of this webinar. Over to you,
Thank you,
Prashant.
sir. Thank you so much, sir. Good afternoon, everyone. First of all, I would like to thank AASB Board of ICI for conducting this session and to give us the chance to moderate the session on SA 240, that is audit responsibility relating to fraud in audit of financial statement. It's an honor to be part of this session and to discuss this essay in a detail. So if we talk about the SA 240, that is audit responsibility relating to fraud in audit of financial statement. So this essay is basically emphasized on the auditor responsibility to obtain a regional assurance that financial statement are free from material misstatement due to fraud and error. And if we talk about, it's also emphasized on the importance of the professional skepticism throughout the audit, relating to assessment of fraud or relating to identification of fraud, to basically to that potential fraudulent activity, basically fraudulent activity. And it also talk about the specific observation or specific observation relating to fraud, basically. So before going to detail of this topic, I would like to introduce CA Anil Gupta sir. So CA Anil Gupta sir is a chartered accountant in 1984 batch. He is also a qualified post. He's also qualified post CA course conducted by the ICAI. That is, he has done the IFRS, DSA, FAFD, that is the Forensic Audit and Fraud Detection, and he's also Center Governor nominee in the Central Council of Institute of Company Secretary of India. So if we talk about his contribution to the profession, so he's remained a member of the various committee of ICAI, including Accounting Standard Board of ICAI, Auditing and Assurance Standard Board of ICAI, Public Finance and Government Accounting Committee of ICAI, Committee of ICAI on Companies Bill for Recommendation to the Parliament, and many more. If we talk about his contribution to the government department, he remained visiting faculty at the Income Tax Department. He has taken the training session and workshop at a various government department and agency, and he has delivered more than 300 lectures at various seminar, conferences, workshop, branches organized by the Institute of Company Secretary of India, Institute of Chartered Accountants of India, and CP Study Circle. If we talk about the awards of sir, so during the year 2004 and 5, 2008 and 9, and 2011-12, he was confirmed with the award by NIRC of ICAI recognizing contribution as a faculty in seminar. And he has also he judged the session at a national conference of students organized by the Odisha chapter, Rajasthan chapter of ICAI. So welcome, sir. Welcome, Paul sir. Now I would request Drishtri Rana ma'am to introduce our second guest speaker, that is Paul Alvarez sir. Over to you, ma'am.
Thank you, Prashant. Thanks.
Thank you, Prashant. Good afternoon, everyone, and welcome to today's webinar. We will be discussing the key points and critical guidelines laid out by SA 240, including how to identify and address fraud risk. As a second speaker for the session, I would like to introduce CA Paul Alvarez sir. He is a qualified chartered accountant and a cost accountant with approximately 27 years of post-qualification experience. Currently, he serves as a partner as SR Bartley Boy and Company, a member firm of Ernst & Young in Pune. He has an extensive experience of working with large corporates, both listed and unlisted, across various sectors, including pharmaceuticals, automotives, and real estate. He regularly contributes articles on professional topics to publications such as the Hindu Business Line, Economic Times, Tech Sutra, as well as his social media platforms. Additionally, he frequently speaks at various professional events. He has been actively involved in various study groups of ICI and has been an invitee to the accounting standard boards of ICI. He is also a member of Hybrid Securities Advisory Committee of SEBI. Thank you so much, sir, for joining us today. Without further ado, I would like to welcome our first speaker for the session, CA Anil Gupta, sir, to deepen our understanding of the comprehensive framework laid out for the auditors by SA 240. Over to you, sir.
Thank you. Thanks, Drishti. Thanks. Very good afternoon to all the friends. At the moment, I am in Delhi and it's raining very heavily here. So happy rainy season too, and happy this. See, the beauty of the rainy season is it's a romantic season. And in this romantic season, I have been asked to speak on the fraud. It's very contradictory. That's how the profession moves. So first of all, let me begin with the presenters. I'm so thankful to the Auditing and Auditing and Assurance Standard Board. I am thankful to my very dear friend Anil D. Lal Saab. He gives so much regard and affection to me. I'm so thankful to him. I'm thankful to all the past office bearers of the Audit and Assurance Standard Board. And secondly, today there is only one speaker, not two speakers, CA Paul Alvarez. So you will be in very safe hand and he will be sailing you through the world of the fraud. I am here just to introduce the topic. I am also thankful to my two very dear friends, Prashant Mishra and Drishti Rana. All the best to you both of you. Let your journey of these lectures continue in the same manner and let you flourish more in the field of presentations and lectures. So let me begin the topic. You see, it's an audit season. So I am, instead of taking you to the technicalities and the complexities of the fraud, because Mr. Paul is there to take care of it. So I won't be intruding and encroaching to the topics that he is going to take. It's an audit season, the September month. So what the audit has to do with the fraud. So I will be throwing more light on that instead of the technical part of the fraud, right? But there are two words that we need to understand with respect to the fraud, and which is what the SA 240 lays down. One is the intentional and other is the deception. So any act which causes any loss is a mistake, is an error. But if it's done intentionally, then it becomes fraud. And more to it, not merely the conduction of the intention is to be there. Someone is deceived by it. So deception means there is a loss to someone. So now if we rope in all these words into three technical words, then the first is that act has to be there. Secondly is the act has to be intentional. And the third is there must be someone who has been deprived of something and who has been deceived. So taking forward, there are two more terms that we need to thrust upon. One is the financial reporting and other are the assets. So financial reporting is our domain. That's what our duty is. That's what the Institute of Chartered Accountant has given us the degree for it, to prepare the financial reports and to report on it. But if the financial reports are fraudulent in manner, then it's a problem. Similarly, if the assets are there, but assets are misappropriated, then there is a problem. And these fraudulent financial reporting and this misappropriation of assets that leads to fraud. After all, why the fraud is conducted? One is the pressure of the management or pressure of the situation or pressure of the conditions, or there are certain incentives. The greed is there. So greed leads to it. And greed leads to not merely in conducting the misappropriation, greed leads to find the opportunities to conduct the fraud. That's the very worst part of greed. So our duty is judgmental, So there are certain tools which help us in finding in which way the management is moving. I will come to it. Then the next issue is, which is very important, is the rapidly changing technology, how it leads to frauds. Then how you come to know whether there are frauds or not. If suppose there are losses in a company, there can be genuine reasons for the losses also, but that's where our judgment and our audit tool comes to help, whether those losses are intentional or those losses are operational. So there are a number of issues which helps us in finding whether those operating losses are actually losses, or is there some intention behind it. Intention can be of number one, funneling away the amounts from the company, taking away the amount from the company. Let me give you 2-3 examples. Very interesting examples are there. Number one is the purchases have been increased. Now, how we come to know that the purchases have been increased? There are very two famous cases. One is of Bhushan Steels, and other one is of Cox and Kings. Now, both these companies are giants. They were giants, and were having global presence. But both of them indulged in misappropriation of assets, as well as in misstatement of the financial statements. What they did, and the type of actions that were done in both the companies are almost on the same lines. I am just giving you 2 examples because I have just to finish before 15 minutes. So first one is related party transactions. So AS18, while you are conducting the audit nowadays, AS18 is of very importance. Related party transactions can be there. They are very much allowed. Some compliances have to be done, which I am not entering into. My topic is not how to conduct the RPT. But in the case of RPT, we have to see why the transaction have been done, whether those transactions are at arm's length price or not. Those transactions can be of expense, can be of income, can be of giving the loan. So once the loans are given in case of related party transactions, then there is a problem. Why the loan have been given. Secondly, whether there is movement in the loan or the loan has stuck up. And giving of loan is allowed. That's a part of 185, 186 section of the Companies Act. Certain compliances have to be done. But point is, how much loan has been given? See, what is fraud? Very interestingly, well, let me tell you a very interesting example before I proceed ahead. Let's assume there is a company in which there is no borrowing at all. Only there are reserves. Reserves means promoters' capital and the profit and loss reserves. Nothing else is there. 99.99% in such type of companies, there won't be any fraud. Because why the promoter need to take out his own money? Why he will like to take out the reserves out of it? Except that he wants to avoid the deemed dividend under Section 222E of the Company Income Tax Act. Then that is something else. Otherwise, he will never do fraud in it. So in 99% of the cases, frauds are found where there are funds borrowed from the banks or financial institutions. वो पैसा मेरा नहीं है, दूसरे का है, और वो पैसा मेरा बन जाए. It's not my money. It's the money of the bank. But I am the owner of that money and I must get that money. Once this thought comes into mind, the fraud starts. So fraud starts with the related party transactions, and the funds are taken out, given to the related parties, and then they misuse it. This is what it was done in the case of Bhushan Steel and the Cox and Kings. Second point. Second point is the expenses are inflated. Purchases are inflated. So purchases are inflated, suppliers are created. In both these companies, you see the mechanism of the fraud was same. They have incorporated around 150 to 200 shell companies, and the owner of those shell companies were the employees of the company which was conducting the fraud. Let's say, if for example we have to take then Bhushan Steel. Bhushan Steel employees were made the directors of the shell companies, and management used to give funds to those companies. Management used to make purchases from those companies, and the payments were made to those companies. And because those companies were shell companies, so the amount was taken out from there. And so in that manner, the amount was diverted from the business and was used for the personal needs and the personal greeds of the management. So how to find it now? And what are the red flags? The very best red flag is, as I said, related party transactions. Second is, only 2 years back, a very necessary and interesting amendment was brought in Schedule 3, apart from many other amendments. Only one which is I am thrusting upon, and that is the ratio analysis. These ratios, if compared, though we have been asked to compare ratios only for 2 years. One is the year for which you are conducting the audit, and other is the previous year. But in our company, we do ratios analysis for 4 years. Once we do 4 years, then we get a taste of it. How much deviation is there, how much diversion is there, how much fluctuation is there in the ratios. Higher the fluctuations, higher the chances of misappropriation is there. So ratios is a very good tool to find the problems with respect to the transactions. Next is the non-moving and slow-moving debtors and creditors. Invariably, wherever there is a fraud, you will find that the related parties, they get stuck up. There is no movement in it. Only yesterday I was conducting an audit, and very interestingly, what happened, they have written off a sundry creditor of 70 lakh rupees. So I asked him, why have you written it off? So we have written off in our books, and the other party, those who have made the supply of which it was the debtor, they have also written off in their book as debtor, and we have also written it off in our books as creditor. We have shown as it as an income. We are paying the income tax on it. Then what's the problem the auditor is having? So I asked a very simple question. The answer was right. His submission was absolutely fine. See, I am writing off, I am showing it as income, I am giving the income tax on it. What's the problem the auditor has? I said, I have a problem. In this world, which is the supplier which says, please don't make payment to me, please write off my account, I don't need the money, you take it as a charity? No one does it, right? So this means this is a red flag. So similarly, in case of non-sticky and in case of sticky debtors and creditors and non-moving debtors and creditors, it helps a lot. Secondly, 3 reconciliations come to our rescue. One reconciliation is 26AS reconciliation. That helps a lot. And second is the TDS. A very interesting case came in just last week when I was conducting an audit. What happened? That's the last example I'm giving you. Okay, it's already over. So what happened? We were conducting, checking the TDS on the expense. When we were checking the TDS on expense, what we found that in case of salaries, they have paid, deposited TDS by excess amount of 25 lakh rupees. Total TDS on salaries was 40 lakh rupees, and 40 lakh rupees, and they have deposited 65 lakh rupees. So I asked the question, why have you done it, sir? A mistake ho gayi, galti se jama ho gaya hai. Very nice. If this has been done by mistake, now what's the solution? So he said, sir, we can revise it. Very interesting. So there is no harm. Yes, the provision is there of revision, and the revision can be done. Then I asked a very interesting question. Suddenly it came in my mind. I said, whose TDS was it? He said, sir, director's TDS. Very interesting. So now my next question is, 31st July has passed. That director must have filed his income tax return. Hanji, return has been filed. So I said, when the return has been filed, he must have claimed the refund. He said, yes, it has been claimed as refund. So I said, when it has been claimed as refund, how can you revise the return? Now the amount is not with the government. The amount has passed away from the government. Return can be revised only once the government is there and the fund is with the government. Then you can revise it. Then you can say this is not to be taken under particular section. It has to be diverted to 194C. It has to be shown under 194I. That can be done. You can swap the sections in the case of TDS payable. But once the refund has been taken away, the fund is not with the government. How can you do it? So very interestingly, they have diverted 25 lakh rupees to the director in such a funny manner that the refund has been given by the government. So what will you call it? It's a mistake. It's an error. It's a fraud. What I did, I will do that. I cannot tell on the stage, but I'm leaving on it on the sweet judgment of all the participants. So I'm thankful to the board for providing me this opportunity. My thanks to Anil Lalji again. All the office bearers of Audit and Assurance Standard Board. My thanks to CA Paul. I had a very nice discussion with him. So you are in very intelligent hands. You are in the hands of a very experienced speaker, very experienced personality. So you will enjoy your journey of next 90 minutes. I am thankful to CA Prashant Mishra ji for using very good words for me. I'm so thankful for your wishes. Thanks
Thank
to
you, sir.
CA Drishti Rana. Thanks to all of you. Thanks a lot.
Thank you.
I think I'll come in here. Okay. Let me just share my screen before I begin. Kindly let me know if my screen is visible, please.
Yes, sir. Very well.
Okay, fine. So thank you very much to Mr. C. Anil Lal for firstly inviting me to speak. C. Anil Gupta for the 20 minutes of experience that he narrated, which was extremely practical, real life experiences. Okay, and that is what really is typically what people try to gain when they come for sessions like this. Thanks to Drishti and Prashant for the introductions. Okay, so we'll get to SA 240. Okay, now before we get there, okay, what am I going to cover? Okay, these are few things that I'm going to cover. One is what is the background and characteristics of fraud? Uh, how do you address fraud risk? Okay, typically, on the identification, what procedures do you perform and how do you document? Then I'm also going to cover on professional skepticism, which Prashant alluded to when he started his presentation. Some common pitfalls which have been realized by regulators, and something which is not core in the in our today's presentation, but which I found relevant is reporting under 143.12. Okay, and reporting under CARO for auditors. Okay. Now, before I begin, the fraud is such a topic which sounds very exciting. Okay, so you tell anyone कि मैं मुझे fraud मिला, and the excitement level just magnifies. Okay, because there is something about it. Okay, in every situation. So the uniqueness of fraud is that there is never a pattern. Okay. And that's the reason making an auditing standard on fraud, you would realize that this probably is one of those standards where the guidance is very directional. The guidance is not exactly in terms of, you do 3 steps and you will be able to detect a fraud. Okay. Why is that? That's because frauds by nature, okay, are different in probably every situation. They are different depending on the nature of industry. They are different depending on what internal control weakness may be there in some organizations. They're different depending on how intelligent the person is who is committing the fraud. So the number of parameters, number of variables, okay, which are there where fraud can occur is it doesn't really have a perimeter. Okay, so it doesn't have a border. It's a borderless kind of a situation. Now, in a situation like this, how does an auditor detect fraud? Okay, um, first important and second also is from an auditor standpoint, how is fraud relevant? Because when we study, our CA, our syllabus, we are told that an auditor is a watchdog and not a bloodhound. And whether you remember anything else in the syllabus or not, this is one statement that you will always remember. So every auditor you ask, he'll say, "Yeah, I'm a watchdog. I'm not a bloodhound." The unfortunate thing is the auditors believe that they are watchdogs and not bloodhounds. But unfortunately, the industry doesn't believe that. Now, why is that? You go with any practical situation, okay, in life that you would have either read, faced, or been part of. If there is a fraud in a company, what is the first question that comes up? The first question which comes up is auditor kaun tha? Okay, which means what? And this is not only people who are investors or people who are not from the audit profession. Even an auditor would ask this. If a fraud happens in a particular company, the other auditor would ask, "Ye auditor kaun tha udhar?" Okay. So somewhere what happens is, even though the profession the profession believes that the auditor is a watchdog and not a bloodhound, still the responsibility of the auditor in a situation where there is a fraud, that responsibility tends to get heightened. So the auditor needs to prove that he did everything possible, okay, that he could have done, and still not been able to detect fraud, which is a very onerous kind of a task. Okay. You have to prove that you did adequate procedures, and in spite of that, you did not detect fraud. Okay. That is one. Second is, nowadays what happens is, as technology is improving. See, I did my CA in a era where there were no computers. Okay, computers had just kind of started, or just begun. There were typists who used to use. There was a computer operator. Okay, today everyone possesses a laptop. Okay, there was a computer operator. In those times, okay, we had manual books of accounts that we had to audit. Okay, and hence conducting fraud was much more easier, and detection of fraud was more difficult. Okay, today, with technology having progressed, and technology even progressing further, the responsibility of the auditor is increasing, because the ability of the auditor to detect a fraud has increased multiple times, because there are tools available by which he can detect the fraud. Okay, and hence today, for one to say that I was not able to detect a fraud through my audit procedures becomes even more difficult compared to what it was earlier, because of the technology tools. I personally, okay, and here I'm not speaking on behalf of the institute, it's my personal view that there will come a time when the profession will say, or the investors will say, that I do not want a true and fair view. I want a true and correct view, because everything can be checked 100% through technology. Okay, at least in certain industries. So which means that the responsibility of the auditor goes up multiple times over. Okay, where there is a client with larger size, let's say you're talking of a company of 50,000 crores, okay, 1 lakh crores. How do you detect a fraud? Okay, thousands of plants. Okay, how do you detect a fraud in such situations? So it becomes even more and more difficult. Okay, having said that, now how is fraud really relevant in a statutory auditor's role, or statutory auditor's responsibility? Let us understand that. Okay, I'll just 1 second, just minimize my screen. Just sorry. Okay, so firstly, what one needs to understand, okay, is that an auditor, okay, what is he doing when he's opining on financial statements? The auditor is giving a reasonable assurance, okay, that the financial statements taken as a whole are free from material misstatement. That is the objective of a statutory auditor. Okay, so you have financial statements, and he's saying, okay, these financial statements do not contain a material misstatement. A material misstatement can occur in two ways. Okay, either through a fraud, okay, or through an error. These are two ways a material misstatement can occur. Okay. And when Gupta ji spoke, okay, he mentioned what is fraud. Okay, there are certain characteristics of a fraud which are different from an error, and many a times you're not able to detect whether one thing is a fraud or an error. He gave a lot of examples. Okay, so coming back, okay, the relevance, okay, for a statutory auditor is because he's opining on financial statements. Those financial statements can have a material misstatement, and that material misstatement can happen either due to a fraud or due to an error. Okay. Now let us understand what is a material misstatement due to fraud. Okay. Which let's call it a risk. Okay. Fraud risk. So the risk of material misstatement due to fraud is the risk that the financial statements are materially misstated, okay, as a result of, now this is important, okay, there's an intentional act, okay, by somebody, okay, that somebody can be people within the organization or that can be somebody outside the organization, okay, and the purpose is to gain an advantage, okay, uh, personal or for the organization. Okay. So fraud always involves an intent. Okay. It can be done by a person inside or it can be done by a person outside. And there is always something to gain by a fraud. Okay. Like Gupta ji spoke of a situation that if it's all of it is your money, then generally the incentive to do fraud is less. But if it's a bank money, okay, or a shareholder's money, okay, whether it's an external shareholder, the incentive for you to do fraud, okay, is much higher. Okay. One thing that you need to remember is that the primary responsibility, okay, for detection of fraud is not of the auditor. Okay. The primary responsibility for prevention and detection of fraud, okay, rests with those charged with governance, which is written in a acronym form. Those charged with governance, okay, which can be the board audit committee and the management. Okay. So they are the ones who are responsible for putting in adequate controls to ensure that fraud does not happen. The job of the auditor, okay, is to check that. The job of the auditor is not to set the controls to ensure that fraud doesn't happen. Okay. Now, the auditor conducting an audit, okay, is obtaining reasonable assurance that the financial statements taken as a whole, okay, are free from material misstatement. We discussed either due to fraud or error. Okay. Now, what you must remember is that when you are doing test of control, see, you cannot check everything in a set of financial statements, right? That's where we do test of controls, we do sample checks. The possibility of you detecting, okay, a error is much higher than the possibility of you detecting a fraud. Correct? So you cannot apply the same method to detecting an error as you would for detecting a fraud. Why? Is because a fraud is very carefully thought through. It is done with an intention to deceive, whereas an error, okay, is an error which happens because of maybe oversight, maybe because the person is not capable. So the possibility of detecting an error, okay, is much higher, and the possibility of not detecting a fraud, okay, is very very high, okay, because there is a mental, what do you say, intent to ensure that you're making money, but you don't want to ensure that it is detected. Okay. Either you will change the sample of the auditor. Okay. Either you will not show him some assets. Either when physical verification is done, you will give him some reason that it is not to be done. Okay. There is an intent out there, and because of which it's very, very difficult, okay, to detect. And that's the reason the procedures that you would do for fraud detection are incrementally different from the procedures that you would do for detecting errors. Okay. Now we discussed, okay, fraud typically involves an incentive. Okay. Incentive in the sense the person has to gain in some form when he is conducting a fraud. If you'd rarely find a situation where fraud, let's say, in let's say local Hindi language, let us call it chori. Okay. Now, person is doing a chori, he has to have an incentive to gain. Otherwise, why would he do the chori, right? So fraud can happen either because of an incentive, okay, that he's getting, or a pressure. Now, what does pressure to commit a fraud means? Let's say you have a PE investor in your company. You have told him that, my turnover, okay, will grow by 30% every year. And based on that, he has betted the money on your company. And your product is not doing so well. In that situation, you are under pressure to perform. A pressure either for turnover, a pressure either for EBITDA, a pressure either for return on equity, and those parameters can keep changing. And I'm linking back to my earlier statement that fraud, there is no set pattern, okay, because the situations can be multiple, okay. So, but the starting point of any fraud is that there is either an incentive or a pressure, okay, to commit a fraud, which causes that person to do it. Second is there is a, so this is the first step, okay. Sort of, sorry, let me just, you know, okay. So this is the first step, okay. Second step is that there is a perceived opportunity, okay. The person sees that he can commit a fraud, okay. कोई चेक नहीं कर रहा है, ओके. सिग्नल पे, ट्रैफिक सिग्नल पे कॉप है नहीं, मुझे पता है कि कॉप है नहीं, there is an opportunity for me to go and commit that, okay. So because there is no check out there, so what does perceived opportunity mean? That there is an incentive or pressure for me to commit, and there is a perceived opportunity because I will not get detected, okay. And third is there is some rationalization of the act. Rationalization of the act means the person is able to justify, okay, the reason why he is doing the fraud, okay. Because whenever a person commits a fraud, remember, he knows he's doing something wrong, okay. So fraud, besides it being an accounting issue, there is a what do you say, a personality trait issue as well. All of us as humans, okay, if you ask 100 humans whether fraud is right or wrong, 100 out of 100 will tell you that fraud is wrong. But then if all of them believe that it is wrong, then why do people go and do it? They do it because of the last leg. They are able to justify to themselves. They create a justification to themselves as to why they feel that this is okay. For example, the example that I gave of the PE investor, that you're meeting turnover, one would say, अरे एक बार किया है हमने, ओके, इसमें क्या बड़ी गलती हो गई ना, फाइनली हम बाद में तो रिवर्स कर लेंगे सेल, इतनी भी बड़ी गलती नहीं है ना, कोई कोई स्टेज में होता है, ओके, हम चोरी थोड़ी ना कर रहे हैं. You understand? You create a justification for yourself on why you believe that the fraud is okay. The other important piece is that honest companies also commit fraud. Honest individuals also commit fraud. So the honesty of a company or the honesty of an individual is not a factor to be considered when you're conducting your audit procedures. Okay. Remember that some of the frauds are done by the most honest people. Why? Because the possibility of detection they feel will not be there. Like sometimes, when you go for audit, you will say that, अरे ये आदमी ना बहुत अच्छा है, okay, ये तो कर ही नहीं सकता, which means what? And then there is another guy, ये तो शक्ल से ही चोर है. So the person who's शक्ल से ही चोर, the possibility of him doing the fraud is low, because people say anyways people knew that he चोर है. But the person who was the most honest, okay, the possibility of him getting detected, okay, will be lower, and hence the incentive for him to do the fraud will be higher, okay. Now what we are coming to is fraudulent financial reporting and management override of controls. Now let me explain to you what management override of controls means, okay. Now whenever you are doing audit, whichever management there is, ethical, non-ethical. Okay, this applies more in ethical management, because in non-ethical management this is definitely an issue. Okay, but even in ethical managements, there are certain controls which a management can override. Okay, and those then become what do you say, a significant risk for you as an auditor. Okay, now what could those be, or how could management override controls? Okay, firstly, by recording fictitious journal entries. Okay, either at the close of an accounting period, or in whatever form. Again, coming back to our example, the company achieved an EBITDA of X. Okay, the company thought that मैं एक काम करता हूँ. Okay, so I'll give you an example. Okay, I was doing the audit of a broker, and this is many years back. Okay, as an intern. Okay, today it's maybe 25 years back. Okay, uh, I was doing the audit of a broker. The broker had incurred significant losses, okay, on his own account. Okay, so as we understand as accountants, the losses on those share trades would come to his P&L. Now, for this broker, the net worth was very important, because based on the net worth, the broker was allowed to trade on the stock exchange. Okay, so his net worth went below the required threshold, which SEBI had set. In that situation, the broker, what he did, the incentive for him out there. Okay, again, he was the management, so the incentive for him, okay, was that he wanted to keep his license on. So he had to meet the 1 crore threshold. So what did he do? He picked up some losses, created fictional customers, and put those losses as customer losses, okay, and showed that as receivable. Okay, right at the end of the period. Okay, bingo, the profit shot up, the performance became superb. Some receivables were there. He told me that those receivables will be paid. How did I detect? I said, okay, show me those customers where there are no bank transactions during the year. Because if you have a fictitious customer, you'll never have a bank transaction there. Okay, so any customer where there was no single bank transaction during the year, you know that these are customers to watch out for. Okay, so management override of controls. Okay, all controls are proper. In the end, the management comes in, puts one entry out there to achieve a particular objective, pressure to perform, incentive, and ease of doing it. Okay. Secondly, inappropriately adjusting assumptions or changing judgments. Okay. Let's say, for example, there is a company is performing very well, and one of the assets gets impaired. Okay. So there is a testing done for impairment. The management changes the WAC rate, or it changes the assumptions of sales growth inappropriately to ensure that there is no impairment of those assets. Okay, these are some examples that I'm just giving you, which are practical and which are just coming to mind. I have not prepared for those examples. Okay, so I hope they are relevant and they bring home the point. Okay. Third is omitting, advancing, or delaying recognition in the financial statements of certain events or transactions. Okay, let's say uh, one of the customers has gone bankrupt. Management is aware of it. भाई ऑडिटर को बता मत यार, उसको बाद में बताते हैं अपन. मैं उसको ना आराम से चाय पानी के लिए लेके जाता हूँ और उसको एक्सप्लेन करता हूँ. ओके, मैनेजमेंट ओवरराइड ऑफ controls. Okay, and they should be taking that adjustment, but they are not taking it. Similar, concealing or not that same example can be relevant in a situation of concealing or not disclosing facts. Okay. Next is engaging in complex transactions. Gupta ji spoke of a situation where a company created hundreds of subsidiaries, okay, to route money, to get the money back, okay. Complex transaction, which are very difficult for somebody to kind of detect, okay. So these are all instances, if you see, of management override of control. So the key theme here is not fictional journal entries, is not assumptions, is not omitting. The key thing here is management override of control. Now, how a management would override a control is difficult for one to put a straight jacketed steps. So it is giving you instances, okay? But why does it become relevant for you as an auditor? If a management overrides controls, the risk of fraud multiplies, and hence it becomes a fraud risk for you. And hence there is a risk that you may not detect it and your financial statements can become misleading. Okay. Now, as far as the standard is concerned, okay, the standard has 3 steps. Okay. So this was all a preface. The standard has 3 real steps. Okay. The first step is you need to, how do you identify fraud risk? Okay. Because your whole, like I said, fraud doesn't have a pattern. Okay. It doesn't have a real method. Nobody can say that तू एक काम कर, तू point A से point B जा और तुझे fraud मिल जाएगा. Nobody can say that. Every situation is different. Every client is different. Okay. Every industry is different. Every person is different. Okay. So how do you identify fraud? There are some indicative factors out there, and what procedures at the minimum an auditor needs to perform. Second is, after you've identified fraud risk, what execution procedures you need to do to address the risk of fraud that you have identified. Okay. And third is documentation and communication requirements. How would you document this fraud? And if required, okay, and if you found fraud, how do you communicate it either to management or, under 143.12 to a regulator? Okay, all of that. So these are 3 things that we will deal with. Now we are dealing with the first element of identification of fraud. Okay. So this is a busy slide, but I will try to make it as simple as I can. Okay. I'm actually in this zone right now. Okay. What I will be covering. Sorry. Okay. So the first thing that you need to do, okay, is analytical procedures. Okay. This is one of the steps that you need to do for fraud risk identification. Okay. Gupta ji spoke of what is called as a ratio analysis. Okay. The same term, a little more fancier term, if I may say, of analytical procedures. Okay. What does it really mean? Okay. Analytical procedures means you take the financial statement numbers and numbers, let's say for 2 years, 3 years, 5 years, whatever numbers are available, quarter, whatever is available to you, and you do analytical procedures, okay, to understand whether there is anything in these financial statements which is totally off from the normal. If it's off from the normal, okay, you may, stumble upon a situation where there could be a fraud risk. Okay. For example, let us look at what those situations could be. Okay. This is again based on experience. Okay. You have a company. Okay. Sales is growing at 100%. Okay. All the rest of the competitors are growing at 10%. What is so great about this company that it is growing at 100% and everybody else is growing at 10%? Suddenly you realize, okay, that the debtors are also high. And even though this company is making significant margin, it has huge amount of borrowings. Is it a reason to worry? The answer is probably yes. Okay. The company is making a margin of 80% when the entire industry is making a margin of 40%. Okay. Is there a reason to worry? Yes, probably there's a reason to worry. There's a reason to understand, okay, what really is kind of happening here. The company has a asset turnover ratio, okay, of let's say 2:1. Competitors, okay, are operating on an asset ratio of 1:1. The fixed asset, are they really those fixed assets exist? Or are there some fictional fixed assets in it, okay, which have been capitalized? Okay. Is there something out there which doesn't exist? These are all elements, okay, on which probably you need to ask questions. It is just like a filter point, if I may say, for you to investigate further. Okay. Because financial statements are numbers, and ultimately, if there is a fraud, okay, somewhere it comes down into the numbers. Okay. So if the numbers are off from what your understanding should be, of what your understanding generally is, then you may want to investigate further. So analytical procedures is one of the bases on which you will identify a fraud risk. The second one, okay, is making inquiries. Okay. This one, okay? Making inquiries. Now, who do you make inquiries of? You make inquiries of management, okay? Now, what inquiry do you do? You ask the management, okay, what procedures they have put in place to detect a fraud or to detect errors or to detect irregularities. A simple thing, okay, I'll give you examples again which are just coming to my mind, okay. Let's say you're in a gold company, okay, a company which is making gold, okay. Is there a risk that there could be a pilferage of the gold? 100%. Okay. You would want to ask what procedures does the management adopt to ensure that an employee does not steal the gold when he's leaving the factory? And 100% the company will have some procedures for it. Okay. If the company doesn't have a procedure, then there is a reason for you to worry, because then your fraud risk tends to get escalated or heightened. Okay. So this is one example, okay, where a management inquiry, okay, will indicate whether there is a fraud risk. Because if the management has strong processes in place to detect a fraud, your risk as an auditor, the fraud risk tends to go down significantly. Okay. Second is, companies which use SAP, for example, companies which use SAP, there is a tool called a GRC tool which sits on the SAP platform. Okay. So what the management does is that the GRC tool tends to have some rule sets which are inserted within the SAP to say that, I'll give you an example. Okay. To say that, has an approval of a PO been done? Okay. If the approval limit was say 10,000, are you seeing 5 POs of 2,000? Okay. Which have been approved on the same day? If there are those situations, please highlight to management. Okay. Some tools which management has set for itself, which would indicate that there is a fraud. If management has some tools in place, their ability to detect a fraud goes up significantly, and your ability as an auditor or your risk as an auditor goes down significantly. Okay. So making inquiries of management, okay, is very, very important to understand what processes they have in place in order to detect a fraud. Okay. And every industry, my friend, every industry, okay, would have different ways in which fraud can happen, and hence different ways in which one would put procedures in order to minimize the fraud risk. Okay. You would also make inquiries with internal auditor. Internal auditor is a guy who keeps doing internal audit, uh, checking controls. A discussion or inquiry with him in order to understand his perception of whether there is a fraud or not is important for the auditor, okay, to understand the level of fraud risk on his client. Third is making inquiries of people, and this is one tool which I use very effectively. Making inquiries of people across the organization. Okay. So one tool, and people who've adopted it would know how effective it works, and people who've not adopted it can use that tool. Ask the same question to 10 people in the organization. Okay. Ask somebody, कैसा चल रहा है business? One guy would tell you that अरे brilliant चल रहा है, बहुत सही. Okay. CFO statement. Okay. Ask the production guy. Okay. सर कैसा चल रहा है business? अरे मंदी चल रहा है यार, कुछ है नहीं, कुछ प्रोडक्शन हो नहीं रहा है. ओके. लास्ट ईयर बेटर था. ओके. आस्क द मार्केटिंग गाय. ओके. जैसे मंदी चल रहा है मार्केट में, come back to your desk and ask yourself what is the disconnect between these three statements. The disconnect probably is that two people are saying that the sales are not good, but your financial statements are showing that the sales are brilliant. So is there a risk that there is some fictitious sale which has been booked? This you will get through management inquiries. Okay. Remember, fraud detection through the books is a difficult exercise, and fraud detection through chatting, observing, uh, professional skepticism, what Prashant spoke of, these are very, very effective tools. Okay. So making inquiries of management is one of the important steps in fraud detection. Third is discussion with audit teams. Okay. Within an audit team, okay, you need to have discussion to understand the views of people, to understand, based on the experience, okay, is there anything the audit team believes that they have observed, okay, which indicates that there is a fraud. I'll give you an example, okay. Again, many years back, uh, uh, there was an intern, okay, and in any audit firm, the intern perceptionally is the most unimportant person, but sometimes he could be the most brilliant. That's what is my belief. So the intern was checking some work papers, and he found a contract, okay, a contract with one uh, shipping company, if I may say, okay, and he said, ये shipping company का contract ना is identical to another company's contract. Identical to the extent that 3 spelling mistakes were also the same. He said, how is it possible that two organizations who are, or one organization, which was a shipping company, which was so large and such a professional company, okay, has an identical contract with another company, okay, which is into shipping, because shipping companies, the legal contracts are very complicated, okay. How is it possible that both these contracts are identical? And one of them turned out to be, of course, we told him that बहुत अच्छा query है तेरा, okay, but अभी तू काम कर आगे, okay, and they ignored it, okay. After 2 years, we ended up with a large fraud on the client, okay, because the other contract was a fraudulent. Remember the fraudster, what he did is he had to create a contract, right? So he just picked up one which he had and created the new contract. Okay. He just changed the name. Okay. And then how he took money out was a different story altogether. Okay. But if we would have taken this forward, we would have realized that, okay, that this is a fraud and it would have been detected obviously. Okay. So audit team discussion is extremely important. What people see when they audit, if they spent some period of time on the audit, when they come for next year's planning, putting their thoughts into the entire planning for fraud risk is an extremely important, exercise. Okay. And lastly is obtaining other information. Okay. Now this, is as broad as it can get. What obtaining other information means: when you're auditing a client for fraud, you need to remember that you need to audit out of the books also. What are analysts saying? Okay, I'll give you an example. There was a company, and I'm not going to quote companies here, okay, because it's a public forum. This company, okay, claimed to its auditor that it was the largest juice manufacturing company, okay, in the country. Now, if it was the largest juice manufacturing company, larger than Parle as well, okay. So the simple thing, okay, is if it's the largest juice manufacturing company, then you should be seeing its products everywhere on the store. If you go to the supermarket, you should see it. If you go to, the mall, you should see it. If you go to see a movie, you should see it. But you actually don't see it anywhere. And the auditor says that this is the and the company claims that this is the largest juice manufacturing company. So linking this information that you see of the management with what you see in reality, uh, checking analyst report, what analysts are saying about the company, checking social media. Social media, you may not want to be posting things on social media, but nothing stops you from reading things on social media. And let me tell you, I'm on Twitter, okay, and when I mean social media, I'm not talking of Instagram, okay. Okay, so social media is Twitter, or similar, let's say, similar forums, okay, where somebody chats of a particular company and chats of something, okay, which should concern you as an auditor. Would you want to pick that up and bring it in some form into your assessment? The answer is yes. So this is what other information means. Other information means anything that is connected out there, okay, that you may want to pick up and bring into your audit procedures for you to check. Okay. The rest of it over here, okay, is stuff which we have discussed, that it's formally called as a fraud triangle. What we discussed, that there needs to be an incentive, there needs to be an opportunity for a person, and there needs to be, a rationalization in his mind as to what is, what is the reason why he's doing the fraud. Okay. So these are, few elements of the fraud triangle. Okay. Then the last is, determining the effect on the financial statements. Like we discussed, once you detect that there is a fraud risk, now you need to decide what work you have to do, correct? So the important thing is the fraud pervasive to the financial statements, which means that it impacts all elements of the financial statements, or it is limited to one caption of the financial statements. Okay, I'll give you an example of a pervasive fraud. Okay, and this has not happened on any client of mine, but I am aware of this fraud. Okay, what is a pervasive fraud? Okay, a client sits at the quarter end and he wants to achieve 1,000 crores of turnover. He's actually achieved only 800. So what the client does, he says book 200 crores of fictional turnover. He books a turnover, he books a sale, he books the debtor. Then he realizes that the debtor's turnover ratio, okay, is increased significantly because these debtors. So this is not the first time he's doing it. Okay, so he's done it many times before. So these debtors are not getting collected, right? So what does he do? Because this becomes an obvious case where the number of debtors days increases. He picks up some of the borrowings and he nets it off against debtors. Okay. When he nets off the borrowings against debtors, the problem is that the interest cost that he has, the interest cost of borrowing increases significantly because the borrowings have reduced, but the interest cost is real, right? So the interest cost looks extremely high. So what does he do? He picks up the interest cost and he capitalizes it. Are you understanding how pervasive this issue has become? It is impacting probably every element of the financial statement. This is a pervasive fraud. Okay. What is the fraud which is impacting one element of the financial statements? The client has booked some fictional sale. Okay. And he's reversed that at the end of the quarter. Probably not a very large number. It's limited to the sales and it's limited to the debtors. Okay. Those two captions of the financial statements. So that is a fraud which is not pervasive to the financial statements, but which is impacting certain elements of the financial statements. Okay. Just move forward. The standard, the auditing standard, okay, presumes that revenue recognition is a default fraud risk. Okay, it's a default fraud risk, which means that it assumes that in every case of revenue recognition, please look out for fraud. Why is that? The reason for that is revenue is the most fundamental thing in an organization. Revenue drives the entire size of the balance sheet in any organization. Okay, larger the revenue, larger the debtors, cash collection, okay, equity, retained earnings, everything comes in from revenue. So the law requires, okay, that you identify fraud in revenue recognition as a default fraud risk. Okay, which means that the risk of fraud is that the organization will book more revenues, okay, than it actually has. Okay, honestly, okay, in today's situation, okay, where we live in a GST world, in India, this fraud risk has reduced significantly. So, for example, in the audits that I do, we would reconcile the entire sales with the e-way bills. The e-way bills will show you whether the goods have reached, whether transporters carried those goods, when it has reached your customer, etc., etc. Okay, but the standard applies to all industries, right? So in certain industries where you don't have the advantage of an e-way bill, okay, or maybe you feel an EVAPL is not effective due to some reasons, okay, or you have a lot of exports, okay, where you don't have an EVAPL, there maybe it will not be effective, okay, but in certain cases, okay, you will be able to reduce this risk, okay, to a manageable level. What the standard also says that if you have not identified, so this part, if you have not identified this as a fraud risk, then please document the reasons why you believe that revenue is not a fraud risk. Now, what could be some of the situations in which revenue may not be a fraud risk? Let's say, for example, I have a client which is into transmission. So the client books revenue every quarter, okay, or every month, sorry, bills it to the government of India, and the government of India pays him. The revenue is decided as per the contract. That contract is signed for 20 years, and that contract will not change for 20 years. Okay. So the number is defined in the contract. That's the number which is put in the PNL, and that is the number which is paid by the government. Okay. Can you say in that situation that the fraud risk is low? Possibly yes, because it is driven as per the agreement. Okay. But in other situations, okay, there is a default fraud risk on revenue recognition. We spoke of management override of controls, okay, and earlier, and we spoke of various ways, okay, in which management override of controls can happen, okay, and that's the reason management override of controls is always just like revenue recognition. Management override of controls is always identified as a fraud risk. The reason being, or as a significant risk. The reason being, management can always interject into the system and do certain things, okay, which can be beyond your normal control environment. And that's the reason it becomes a fraud risk. Okay. So what do you do in such situations? Okay. You check year-end entries, okay, journal entries, okay, which are passed at the end of the reporting period. Okay. Check entries, okay, for unusual transactions. Okay. And stuff like that. Okay. So these are situations where management override of controls, okay, is an important element for you to evaluate, okay, from a fraud risk perspective. Related party relationships, okay. Gupta ji spoke of related parties briefly. The possibility of you doing a fraud in a related party transaction is very high. Why? The reason is because you're controlling both ends of the transaction. Why is law so difficult on related parties? The law is difficult. So whenever you see related parties, any regulator, his antennas will go up. Why? Is because in a normal transaction, you have control only on yourself. On a third party, you don't have control. Who's the buyer? In a related party transaction, okay, you control your side and you control the other side also. Which means what? You control the timing, you control the amount, you control the profitability, you control the write-off, you control everything in the transaction. And that is the reason the related party transactions per se, okay, become an important element when you're doing fraud risk assessment. So if you are having a client which is having significant related party transactions, the possibility of a fraud risk, if I may say, okay, in a related party transaction is much higher than compared to a unrelated party transaction. So depending on your risk assessment, assuming that it is high, you need to design and perform procedures to obtain evidence that these transactions are okay and ensure that the terms of the transaction, okay, and the extent of dealings, okay, you are satisfied with this. Okay, so related party transactions is important as a linkage to fraud risk is because of the way in which the transactions are done and the difference in those transactions compared to other transactions with third parties. So we discussed some of this earlier that, when we do a risk assessment of fraud, first thing that we do is do inquiry with management. Okay. We also discussed about inquiring with internal auditor, okay, because the internal auditor is an important guy who's doing control assessment and stuff like that, and that's the reason inquiry with him is important. Okay, we discussed about all the inquiries which are to be done, so I won't delve too much into this slide, but I'll just touch upon it. The auditor's inquiries of management provide useful information concerning risk of material misstatements. So if a management itself has set certain controls to prevent a fraud from happening, it is great for an auditor, which means his risk is lower, risk of material misstatement. If the management doesn't have enough controls, okay, let's say for example, you're doing an e-commerce company, okay, कौन सा प्रोडक्ट बिक रहा है, कितने में बिक रहा है, किसको कितना डिस्काउंट जा रहा है, nothing is under good control, you would say that the risk of fraud is very high. I remember a company where one of my friends, he was into he was a shoe retailer, and he told me that I'm not going to name the e-commerce company. He told me that I put up my shoes, okay, on XYZ site for sale, okay, and I sold my shoes, let's say for 500 rupees, and it got listed on the platform, and it did not sell, okay, for 6 months, okay. So they had a discount scheme, and I purchased the shoes back in another company of mine, okay, at 200 rupees. I became very concerned, okay, because whoever was the auditor of that e-commerce company, whether he has enough checks and balances to check that his vendors, what they're supplying to him, are they the same guys who are purchasing back when discount schemes are kind of announced, okay. So it's just one kind of an example, okay. Then inquiry of internal audit, okay. What procedures, okay, is the internal auditor doing, okay, to detect fraud, and whether management has satisfactorily responded to his observations. Many a times what happens is internal auditor raises points, but nobody, they don't respond satisfactorily. You as a statutory auditor may want to see that and see whether some things resonate with you, okay, and you may want to do additional procedures out there. Then we spoke of discussing with those charged with governance, okay, in terms of their view, okay, on whether there's a fraud or not. This part is important. Like I said, in case of fraud, it's very difficult sometimes to know whether somebody would do a fraud. It's very difficult to know how a person would do a fraud. And it is very difficult to check someone's integrity. For example, look around you. You may have 10 friends. Very difficult for you to say which friend is a chore and which friend is not a chore, right? Which friend would react how in which situation. So just imagine you're doing an audit of a company, okay, and you have to check integrity of management. Why is integrity of management important? Integrity of management is important because if a management is not integral, okay, then your risk as an auditor goes up significantly. I always tell people, the trial balance is a way through which you know the character of the management. भला वो प्रेस में whatever the management says doesn't matter, but what you see on his real books is the real character. So when you see the books of accounts, you know what kind of a management it is. You know what they do. You know how much to trust them. You would know what things to verify and what things to take on face value. All that is important from a fraud risk perspective. Then testing journal entries. Okay, we spoke of management override of controls. Okay, so when you're checking management override of controls, you need to check journal entries. So basically, when you're looking at journal entries, okay, why are you looking at journal entries? Because you're looking at journal entries because those are the outside the books transactions, if I may say. If you take an SAP, there are certain transactions which keep happening through the normal process. Then you close the books, and then the management says, okay, boss, मेरे को ना sales बढ़ाना है, मेरे को sales कम करना है. So journal entries checking is an important element, okay, for an auditor when he's checking, when he's doing fraud risk. Okay, so this basically is coming to the point, okay, of checking the execution, okay, of the risks that we are talking of. So this part, okay, is important. Some of these key procedures, okay, is important. So IP is basically information provided by the entity. Okay. So when you're doing checks, okay, it's important for you to check authenticity of scanned documents. Okay. I'll give you an example. Okay. I had a client. Okay, where again many years back. Okay. Uh, so we there were certain sales made. Okay, to certain parties and they were outstanding at year end. Okay, and we asked for confirmations. Okay, and these parties. One was based in India, one was based in Singapore, and one was based in US. Okay, so we asked for confirmations from these parties, and we got the confirmations. Okay, excellent that you got the confirmation from the party. You looked at it and you said, "Great." Okay, when this came up for review, we realized that the ink was the same in the three confirmations. Okay, and the ink was a typical blue, a very different kind of a blue. So we told the client, यार तुम सब सब कस्टमर्स को तुमने पेन गिफ्ट किया है क्या, कोई स्पेसिफिक टाइप का, शेफर का ब्लू गिफ्ट किया है क्या? Client said, why? So all the confirmations have the same ink, yeah, and that too a ink which is not a regular type of ink. So the guy who was handling debtors, we told him, show us your pen. No? Pen was the same. Okay. So being, having that intelligence to look at the document and check authenticity hai kya ye document mein. Okay. Then automated techniques for J testing. What this automated techniques means is, if you're auditing, some of the companies which I audit, they are in the range of, let's say, 30-40,000 crores. Okay. Now, when you're checking a company with 30-40,000 crores of turnover, can you check every J? It's impossible for you to check every J. Okay. So you need to use certain tools. Those tools enable you to remove the noise. Okay, so for example, if there's a J, which is an automated reversal entry, okay, some entry put at year end reversed automatically by SAP, which is defined by SAP, you may want to remove that out. Okay, certain entries which are management entries, okay, which are MIS entries, you may want to remove that out. Okay, so you use automated entries to remove out the noise so that you're able to focus on those entries, okay, which really you want to go and analyze. Okay, so that's what automated entries would mean. Also using as same with audit tools and using whistleblower, reviewing the whistleblower mechanism. Whistleblower, according to me, is an extremely powerful tool. Maybe in India it is misused, okay, where people don't put real complaints in whistleblower. But many a times when you see whistleblower, because the whistleblower is an independent guy, okay. If you see whistleblower complaints of a particular pattern, they should worry you as an auditor if the pattern is something that has not been there in your list of fraud risk. Okay. The third piece that we are coming to is documentation. Okay. So first we spoke of identification of risk, secondly, execution of risk, and third is documentation. Okay. So what do you need to document? Okay. You need to document how you identified those risks. You need to document what are the fraud risk factors that you believe as an auditor, okay, are relevant. You need to decide how these fraud risks link with the financial statements. Okay, so this assertion level and financial statement level as a whole is basically how do you link these fraud risks to your financial statements. Then doing work on management override of control. So which aspects of management override of control you feel are relevant, okay, in case of your client. And then for revenue recognition, we discussed that if you're not identifying revenue recognition as a fraud risk, the government example that we took for power, okay, you will need to document the reason. And for every identified fraud risk of material misstatement, certain details, okay, as to how and where the fraud could occur, okay, and the potential effect and the controls which the management has in place. Okay, this needs to come into the documentation. In terms of communication, okay, significant deficiencies in internal control, you need to communicate to management and those charged with governance. This is there as part of your ICFR also. If you find significant deficiencies, it is important for you to communicate those with management. And when we identify fraud, okay, we have to communicate it to management and those charged with governance. And additionally, now we also have a communication to the MCA if you're doing, audit of a company under the Companies Act. Professional skepticism. Okay, this is one element which I wanted to take, and thanks, Prashant, you raised it right at the start. Okay, professional skepticism is a trait, is a ability, okay, to see things which a normal person wouldn't see. I'll give you an example. When I just began my career, I was auditing with another colleague. Okay, he was an intern and I was a qualified that time. Okay, and I was explaining to him ki, how manipulation can happen in a particular transaction. Now, this guy was a Parsi, a very, jovial and a straightforward Parsi. So I was explaining to him how management can, do a fraud in this case. And what he was trying to explain to me is why would they do the fraud? He was just not able to understand as an intern as to "वो क्यों चोरी करेगा?" He just couldn't understand that. Okay. So for him to audit was very difficult. Okay. And fortunately today in career, okay, he's doing very well, but he's not an auditor. Okay. So, so professional skepticism is very, very important. Now, what does professional skepticism mean? Professional skepticism means you just need to be alert at what you're seeing. Alert in terms of, अरे यार ये कस्टमर का एड्रेस और मेरा एड्रेस सेम है. Is it a reason to worry? Yes. Okay. Promoter, okay, is in deep debts, but you can see fancy cars, okay, being driven by the promoter. Is there a reason to worry? Yes, there is a reason to worry. Market is saying something about the company, and management is saying everything that they're saying is wrong. Is there a reason to worry? Yes, there is a reason to worry. So professional skepticism basically means it's an attitude. Okay. You can never say that, X guy, these three things, okay, you do and you have professional skepticism. Professional skepticism is an attitude. One, you need to have a questioning mindset. Whenever you see something, it needs to ring a bell in your mind in terms of, boss, who's lafda hai kya? Okay. This is what it's like a cop. Yeah. Okay. When you see a cop, okay, when he sees something, even if you're his friend, he would notice it. If he finds something wrong, whether he tells you or not is not important. He will notice it. Why does he notice it? Because they're trained that way to have a alarm going in their mind, okay, when they see certain things. Okay, so one is having a questioning mindset. Secondly, being alert to conditions that may indicate some possible misstatement or fraud. Okay, withholding judgment until sufficient appropriate evidence is gathered. This is very important. The moment you see something, okay, you shoot the bullet. That is not appropriate, because some things, the way you see it, and some things which are facts, there could be a significant amount of difference. Okay, so you need to gather evidence to establish that what you're thinking and what is there. There is a alignment between the two, and recognizing the circumstances, okay, that may cause the financial statements to be misstated. Okay, so professional skepticism is an important piece. I'll take 10 more minutes and then we'll open it up for questions. Okay. Uh, these are few key themes which have been observed by regulators. Okay. In terms of regulators means ICI, NAFRA, etc. Where are auditors typically falling short, okay, in terms of their compliance with SA 240? Firstly, they are not able to identify appropriate fraud risks. Okay, that's what regulators feel. Even after they identify, okay, the procedures which they are doing, okay, those don't seem to be adequate, okay, either in terms of the walkthrough or in terms of the testing. Okay, these are few observations from auditors, from the regulators. So this was on SA 240. Now, I'm just covering few things on fraud reporting under the Companies Act. Okay. So under 143(12), okay, if an auditor in the course of performance of his duties has reason to believe, okay, this reason to believe is important, that an offense of fraud, okay, involving an amount of 1 crore, more than 1 crore, is detected, then firstly he needs to inform the audit committee within 2 days of detection. Audit committee needs to get back to him within 45 days, and then he needs to file a form ADT 4, okay, with the MCA, informing them that a fraud has been detected. If it is lesser than 1 crore, okay, you don't need to report it to central government. Okay. Now the key question here is, the position earlier, okay, was that an auditor in the course of his performance of his duties as an auditor. So the interpretation of 143(12) was that if an auditor finds a fraud, only then he needs to report to central government. Okay. But MCA, NAFRA has come up with a circular, okay, which on 26th of June 23, which states that in whether the management detects the fraud or the auditor detects the fraud. If the fraud is more than 1 crore, okay, and he believes a reason to believe that an offense of fraud of more than 1 crore is there, then he needs to report it to the central government. Okay. Important thing is under 143(12), it covers only frauds by officers and employees of the company. When we went to the definition of fraud earlier, we saw that fraud can be committed by somebody inside as well as outside. Okay. So third party frauds, okay, are somehow not covered under 143(12), but they're covered under CARO. Okay. And we'll come to that. Okay. And plus the board's report, if there is a fraud, the board's report needs to have certain disclosures, okay, giving the nature of fraud, description, and various other particulars. Okay. I'll just skip through things which are, kind of not important. Okay. So this is a slide, okay, where it says that if there is a fraud of more than 1 crore, okay, and it is not mere speculation, okay, it is reason to believe. Now, reason to believe means you are, remember, detection of fraud is not the auditor's responsibility. Okay. So detection of fraud is not the auditor's responsibility. So if there is, the auditor suspects a fraud and he goes in terms of evidence beyond that element of suspicion, where he has certain uh, evidences which do indicate that there is a possibility of a fraud, then if it's an entity which is governed by NAFRA, okay, he needs to report that to central government. Okay. And if it is a non-NAFRA entity, okay, then if the auditor is found the fraud, then definitely he needs to report it to the central government. And if the management is found the fraud, okay, he need not report it to the central government. Okay, these are few things, in terms of suspicion and reason to believe. The term which is used is reason to believe. Reason to believe means there needs to be sufficient information or convincing evidence beyond suspicion, okay, that somebody is committing a fraud. If that is the case, then you and you have little bit of evidence, then you must and it is more than 1 crore, then you need to report it to the central government. Now, whilst the 143(12) uses the term offense of fraud and ADT 4 uses the term suspected offense of fraud. Okay. Now that's the way it is worded. Okay. But if you read harmoniously, It is only applicable when the auditor has reason to believe, okay, that a fraud has occurred. Now coming to CARO, clause 312 of CARO requires the auditor to report whether any fraud has been noticed or reported either on the company or by the company during the year. This part is as simple as it sounds, okay? It may not be that simple, okay? Very few people would have seen a situation of this. How do you decide that this is a fraud by the company? So let's say, for example, okay, you are auditing a company. Your company is entitled to certain incentives. And those incentives, let's say, theoretically, your company is entitled to an incentive which is based on certain assets. And the number of assets or the value of assets has been misreported by the company, and based on which the incentive which the company has got from the government is higher, and that amount is material, okay, it will be a fraud by the company on whoever. Okay, so that is an example of a fraud by the company. Fraud on the company is simple. Okay, someone has committed a fraud on me. Now this goes back to the earlier definition of fraud, that it could be by people inside also, and it could be by people outside also. So if you notice the CARO reporting as compared to 143.12, which requires only employees and management, the CARO reporting requires fraud, okay, which is noticed or reported on the company by anybody, okay. So even if a third party, okay, is involved in the fraud, okay, fraud committed by employees or third parties, okay, may be treated as fraud on the company, okay. So all those have to be kind of reported. And if a fraud is reported by an auditor, he is required to report the nature and the amount involved. Now this, even though it is as simple as it has been written, okay, the most difficult thing in a fraud is to determine what is the amount of the fraud. Okay, because there is no internal control on fraud, right? Correct, because a fraud is a breach of internal control. There's no internal control. So whenever you have a fraud, you will notice that at max, you will have only an estimated amount. You will never be able to determine an amount. And hence, in many cases, this is a difficult thing to kind of report on. But this is what the law requires you, if at all you have the amount determined. Okay. Then under clause 11C, the auditor is required whether he has considered whistleblower complaints. Okay, this is another clause of CARO under which the earlier one was under clause 3.3. This one is under clause 311C. Okay, so where the auditor is required to report whether he has considered the whistleblower complaints. Why whistleblower complaint is important? Because some of the whistleblower complaints may indicate, okay, a fraud risk, which the auditor should consider when he is doing his fraud reporting or fraud risk assessment. Okay. The other we discussed also discussions with the internal auditor. So one more place, okay, in CARO, it requires the auditor to read the reports of the internal auditor and consider that, okay, when he's doing his procedures. So if the internal auditor has identified certain elements, okay, which do indicate the possibility of a fraud, the auditor is obligated to read his internal audit reports and factor those elements in his fraud risk and then perform adequate procedures. So that was all from my side. Okay. Now, I hand it over back to Drishti and Prashant. And if there are any questions, okay, or you'd like to moderate, I'll stop sharing my slide if you permit.
Sure. Sure, sir. Thank you. Thank you for this detailed learning. So when I was reading this stand-up before this call, so the certain question came to my mind. So I want to ask that. My first question is, to what extent auditors should rely on the management anti-fraud program when assessing the overall fraud risk? Should we rely, 100% on that programs, or how we deal with that?
So instead of an anti-fraud program, the way I would put it is whether the management has certain processes that they have in place to prevent fraud or to detect fraud actually. Okay. Some could be preventive and some could be detective processes. If those processes have been set by management, I think the best way is to trust those processes unless in your testing journey you have realized that those do not function well. If so firstly, fraud detection is difficult. Okay. Second is, if they already have a process in place, the best way to do is to rely on those processes. Okay. If during your process checking to control testing, you realize that those processes do not function at all, it's only in theory and nobody looks at it, it's only on paper, then you may not want to rely on them. Okay. But at the base, you may want to rely on them.
Okay. And my second question is, in case where the auditor detect a red flag, but he cannot substantiate that fraud. So what should be their next steps?
I'm sorry.
He found some red flag, but he cannot substantiate that is a fraud. Fraud. So what would be the next step?
So see, the first thing is, let's say he finds a red flag.
Yeah.
Okay. Then his obligation, okay, is to do further procedures, okay, on those red flags. Let's say, for example, okay, I'm just trying to give you, if I can, an example that let's say, an auditor is auditing a company and he feels that some of the sales, okay, the company is not recording in the books. Okay.
Okay.
It's promoter, and let's say it's a business which is a cash business. I'll give you an example. Look, a practical example. Let's say somebody is running a business of a mall, okay, and he has a shop in the mall, and he has let's say it's a large brand, okay, and there is a decent amount of money which is received in cash, even though that is reduced significantly today. And you, as an auditor, believe that he doesn't disclose everything to you, and some of the cash is being siphoned off by the uh, promoter. Okay, so this is your suspicion. So we are just defining, okay, what your suspicion is. Okay, what you would do as an auditor is you do processes. What's the first process you'll do? You'll do inventory reconciliation. Okay, you may find certain gaps. Okay, then all of those gaps will not be reconcilable. Okay, because let's say it's a typical food store or a clothes store. Okay, you may find gaps by nature of business, but large part of those gaps are justifiable and the management is able to adequately explain, or you as an auditor may stop there. But you are in a situation where the gaps are so large that you feel that there is a problem. You firstly will qualify his internal controls because you're not able to get adequate explanations. If you believe that the quantum is so large that it's pervasive to the financial statements, you may qualify as financial statements. You go further down, okay, that it is really so large that it's dependent on, many people are dependent on it, it's pervasive to financial statements, it is something that you just cannot do anything about, and the management, okay, is not adequately cooperating. In that situation, you may choose to resign from the engagement. I hope I answered your question.
Yeah. So we have some question from participant also. So one of the questions that I'm taking right now, that there are proceedings currently initiated by the GST authorities with respect to fake ITC passing and issuance of tax invoices without actually supplying goods and services, which are not yet proved in the court of law. How this is to be addressed by auditor in their audit report?
Yeah, so effectively you're saying that the client has claimed fake ITC, okay, or the client has issued fake invoices, okay, and this is an allegation, you need to substantiate whether, firstly, you need to do procedures to justify yourself. In fact, this is a very simple thing. Okay, you need to do procedures, extensive procedures. Okay, to satisfy yourself that these are not fake. Okay, how would you do that? Okay, today it's very difficult for one to do fake invoices. Okay, there is a e-way bill, and maybe people have ways around that also. Okay, if you believe your client has ways around that, then you need to question your client acceptance in the first place. But I'm assuming that if the client acceptance is okay and there is a allegation which is not correct, and you need to establish as an auditor and satisfy yourself that it's not correct, or you can check the e-way bill, you can do inventory reconciliations, you can check subsequent collections of debtors. Okay, you can check, you can call up third parties, confirm with them, unrelated parties. All of those processes you can do. If you're not able to do those processes, then like I said in the previous question, you always have the ability to work out as an auditor.
Okay, thank you, sir. And one more question that I'm getting is, as per Section 447 of the Companies Act 2013, 1% of turnover or 10 lakh, whichever is lower, is a material fraud. Whether we have to report the value below the limit.
Okay, so I'm not able to recollect this section
Okay.
correctly. Okay, what section did you mention?
447 of Companies Act. 440.
Let me check, because coincidentally I have the Companies Act in front of me. Okay. 447 you said, is it?
Yes.
There is no section 447. Section 4 is memorandum. Okay,
447. It's a 447.
447. Okay.
Yeah.
Section 447.
Yeah.
Okay, got it. So as per me, 447, okay, is a section which is on punishment for fraud. Okay. I do not see a materiality definition put in there. Okay. But generally speaking, under principles of auditing, fraud never has a materiality. Okay, whilst law may have, let's say 143.12 may have created a materiality for a regulator, okay, to decide what the regulator wants to track. But for example, if I see a client even with a 10 lakh fraud, a fraud is a fraud. Let's say somebody is doing a GST fraud, okay, and the company is 50,000 crores turnover, and you find 100 crore of GST fraud. Will you say that, I'll pass it off on materiality? The answer is no. Okay, so fraud generally does, see, when I calculate, like I said, in case of fraud, you can never know the number.
Yeah, correct.
When people say that उसने ना लोचा किया है, just notice that लोचा किया उसने ना 100 crore का लोचा किया है. Tell him to show the calculation of 100 crores. He'll not have it. It will be some number which is calculated on a calculator. Okay, so fraud generally doesn't have completeness, and hence it theoretically cannot have materiality, and you never apply a materiality threshold for a fraud. See, fraud comes to integrity, right? Let's say, I mean, in this gentleman's example, let's say the fraud is done by management. It comes down to integrity of management, and it becomes a very large issue. और मेरा पर्सनल बिलीफ ऐसा है कि चोरी जितना छोटा है उतना रेपुटेशन रिस्क ज्यादा है. किसी ने बड़ा चोरी किया तो एनीवेज बड़ा चोरी हो, लेकिन छोटा चोरी अगर उसने किया तो वो बड़ा चोरी भी कर सकता है.
Correct.
Okay.
One more question, sir. What are the common indicator of fraud in complex financial transactions such as mergers and acquisition? The common factor that we can,
see
see most of the situation. Yeah.
See, and again, I'm not coming by any specific situation. Okay, I'm just telling you based on my experience. Okay, which could be based on past 25 years. Okay, typically one of the red flags in merger and acquisition is, uh, are they trying to cover up something? Okay, let's say one company has lot of write-offs and fake transactions, is trying to merge with another company which is good, okay, to hide its situation, as happened with one large case, which I don't want to quote, okay, which is now almost 10-15 years old, okay, for a software company, okay.
Yeah.
The merger which triggered the entire thing, okay, was certain fake transactions, okay, which happened. Second is playing on fair valuation, okay, increasing values beyond what the values really are, okay, to show a better performance to an investor, especially if you're doing mergers and acquisitions which are before a fundraise, then you need to be careful. And in today's times, okay, as you are aware, if you're doing mergers with subsidiaries or entities under common control, okay, those are typically done at book values. But if somebody is trying to breach that and do it at fair value, okay, then you need to ask a question why he wants to do it at fair value. Typically, if somebody is having a lot of land, he may want to do it at fair value, okay, and is he going to do fundraise on the basis of that fair value? These are all questions which come in. What you should actually check is the reason for the merger and acquisition. Okay, if there is no reason for the merger and acquisition, then should not rest till you actually get the reason.
Okay. And one more question, that is last question from my side basically. So how should auditor respond if management is suspected to be involved in fraud?
If management is suspected to be, you just resign. See, the great thing of being an auditor, the great thing of being an auditor is the power which an auditor is given under Companies Act. I don't think before the 2013 Act, the auditor had so much powers. So, see, if as an auditor you fear your client, then you can't be a good auditor. Let me tell you that. Okay, you can possibly understand management's point of view. You can do all of that, and you respect your client, but you don't fear your client. Okay, so if your client is fraudulent, and I'm presuming that in this gentleman's example, the fraud is large to cause a concern at the relationship level, then you just walk out. And the law puts so many restrictions on the auditors that if your fraud is large, you need to get government involved, because the government wants to know, if the company is doing a fraud of more than 1 crore, and 1 crore is a small threshold in today's corporate environment. Okay, it's a small threshold. So if any fraud more than 1 crore, government is saying, let me know, means you are the messenger to the government. If you are the messenger to the government, then you have a choice. If you want to side with the management, then you are also equally fraudulent. And if you want to walk away, then walking away without telling the government is even a bigger risk for you professionally.
Okay, that's it from my side. Christy, you have any question you may ask?
Yes, thank you, Prashant. Thank you, sir, for all the practical examples that you quoted while explaining the topic. So I have a question. It's with regard to the shipping company fraud that you mentioned. So I wanted to understand that how the auditor can balance the thorough fraud investigation with the practical constraint of time and resources they have. Like in your example, while you were doing the audit, so you asked the intern to focus on other things, and that the area that he highlighted, it was a let go. So what are the best practices for managing the balance without compromising the quality of the audit?
See, this is a good question. Okay, so we are all up against time. Okay, the good part is that and here I'm giving you a practical way out. Okay, If you notice something, okay, during your work, which is a red flag, let's say during a quarter review, you notice something which you feel that is not right. You put it in a parking slot, and after your deadline is over, you spend time on that area and convince yourself that this is all right. Okay. So you will notice many a times when you're doing the work, because let's say your client closes in 30 days or 45 days from the end of the quarter, if it's a listed company, you notice certain transactions out there, but you don't have adequate time for the management. You're not sure whether the management is involved or not. And you believe as an auditor that you need to gather enough evidence in order to make a case that this is a problem area. So you park that, put it in a parking slot, and then after the quarter is over, you spend adequate time on it. That's the best way, I think, practically for one to handle it.
Thank you, sir. This is very helpful. So the next question that we have from our participant is that it is regarding the materiality of the fraud. So we understand that there is when materiality is concerned, there is a matter of judgment and ambiguity which is involved. So when we audit, and we found that the magnitude of the fraud is very minuscule, but if it is continued, it may have a larger and adverse impact. So how should an auditor handle this situation in their reporting, or a separate management letter is required?
So I'd like to clarify one thing. Materiality is for errors. Materiality is not for fraud.
Yeah, you mentioned earlier also.
Can you tell a client तुम चोरी करो, लेकिन यार चोरी छोटा चोरी करो? Okay.
Oh, no, sir.
You cannot do that. Okay. Any chori is a chori. Fraud doesn't have a materiality. What you're trying to detect, materiality, where does the concept of materiality come in? Let's say, for example, the auditor does 100% check of the transactions. Probably then the only place where materiality is relevant for him is when he's making his audit report, but not in his test of controls, because he's checking 100% of the transactions. Okay. So he's checked every transaction and he's confirmed that there is no error. But if there is a fraud, firstly, you can't determine the amount. And if you can't determine the amount, there is no materiality. And like I said, chori jitna chota, utna reputation risk jada.
Right. So there is one last question. It is regarding the excess and fictitious stock reporting to the banks. The client has reported excess and fictitious stock reporting to bank for availing the credit facility. And it may or may not be a part of books of the accounts, or maybe partly a part of books of. The question is quite ambiguous, but I think the participant want to understand how the excess of fictitious reporting which is done to the bank to avail the credit facility, and if as an auditor we found that it is not correct.
Drishti, I can't hear you.
Hello?
Yeah, now I can hear you.
Sorry. So I'll just
So
reiterate the question.
I'll try to answer it. You let me know whether, in the interest of time, you let me know whether I've answered your question. So the question is, if my client has reported fictitious inventory receivables to the bank in order to obtain working capital facility, what is my responsibility as an auditor?
Yes.
So firstly,
Yes.
on Caro, under Caro now there is a lot of people used to do this. So they plugged this through putting the responsibility on the auditor, that all the reporting of inventory and other elements which need to be done on a quarterly basis to the bank needs to be checked by the auditor, and it has to tally with the books of accounts. So if it's not tallying with the books of accounts, okay, then the auditor needs to needs to report it. And if there is a fictitious reporting, then I think you come back into. So this is very common, okay, in certain types of companies, and it is very auditors carry significant risk out here, because if the bank loses money, or they'll come after the auditor. Okay, so hence for the auditor, the fact that the question is being raised means that there could be a situation which the person is faced where there's an actual fictitious reporting of inventory. In that situation, you need to ensure that you get that rectified. And if you feel that it's being done persistently, okay, then you need to report it as a fraud to the central government if the number is more than one.
Thank you so much, sir. Prashant, if you have any questions left, we can take up. We
No,
have
I
5
don't have
minutes
any
left.
questions. Now. No, I don't have any question.
Thank
I
you so
hope-
much, sir.
I hope I've been okay. It's a difficult topic to teach, so to say, but I hope I've tried to make it
No,
as
sir, it was
Yes.
wonderful deliberation from your side. You have covered all the related aspects relating to SC 240 and covered all the question answer session questions also. So, on behalf of Auditing and Assurance Standard Board, I extend my heartiest thanks towards you, sir, for such a wonderful deliberation and covering and enlightening all of us and all our members with your expertise. I also thanks to the towards CNL Gupta ji in his absentia for the keynote address as well as his opening remarks. And I also thanks both the moderators, Distri Madam and Prashant ji, for wonderfully moderating this today's webinar. I also thanks all the participants for their participation. Once again, thanks to Paul ji for giving us this your precious time. Thank you so much.
Thank you so much.
Thank you. Thank you so
Thank
much.
you.
Thank
Thank
you.
you.
Bye.
Thank you.